Hey everybody, I'm Ryan with Propelio. Today we have Robert Greenberg in from Patch of Land. We're going to be talking about crowdfunding and crowdsourcing and all those ins and outs and whatnot. Before we get into that, I just want to tell everybody that if you're watching this for the first time, who Propelio is, what we are. Yes, we do these daily video vlog, blog, chogs, videos. We like to pride ourselves in being real estate investing. But the reality is our company, we provide investors with access to true MLS comps, to off-market lead lists, and to lead management. So if you are actively being a real estate investor or if you're trying to get into that game, check us out. We do a 7-day free trial, so go to www.propelio.com. And maybe I shouldn't have said it with a voice, but propelio.com. Nice. Give us a check. Robert, what's up, man?
Good morning, welcome. Thanks for having me.
There we go.
Yes.
I've known you for a couple years now.
Yeah.
First of all, before we get into Patch of Land, before we get into crowdfunding, crowdsourcing, who are you? What's your background? What do you do?
Yeah, so I'm the Chief Marketing Officer at Patch of Land. We're an LA-based company. We basically a private money lender. We lend in 45 states around the country. I got into this, I guess originally about 2008. I've been in the lending side since 2013 when I was with B2R Finance. I think that's where we met initially. We were one of the original portfolio lenders for the rental property space. And I've been with Patch since mid-August 2016.
Okay. And crowdfunding, I know that could be a large topic, and hopefully we can get into all those ins and outs. And open invite if you're watching this. Obviously, if you have questions, chime in at any time. So on the very surface level, what is crowdfunding?
Well, let's go back to when our company was founded in 2013. Obama signed a piece of legislation called the Jobs Act in 2012, which allowed companies to raise money direct from individuals without having to go through the SEC or without going through an equities or buying stock, and so it was direct to consumer fundraising. So
is it that whole same as like crowdsourcing, crowdfunding, everything?
Yeah, I mean, generally this industry is considered crowdfunding, and we're a little bit of an unusual animal because we've kind of got two businesses in one. We're a private money lender and we're a crowdfunder, and we can talk more about how that works. But the company started with two guys, and they were in Chicago at the time. Brothers, Brian and Jason Fritton. They, as that legislation came about, they saw a really interesting opportunity to kind of disrupt what is basically the hard money industry. Hard money lenders are typically work off their obviously private money, their own funds, and they can dictate whatever rates and points that they want for very short term, what's basically short term interest only money that obviously real estate investors have become very fond of in order to help fund their investments.
And as far as the act, like what was the act again? The Obama.
It was the Jobs Act, JOBS. It was signed into law in late 2012, and again, it allows companies to raise money from individuals directly.
Now, are you ready for truly stupid questions?
Sure.
So, is this kind of like the whole Kickstarter thing?
Yeah, really. That's most people when you hear crowdfunding, you think of Indiegogo or Kickstarter. Absolutely.
Hey, my grandmother broke her ankle. Give me some money for her.
Yeah, I mean, similar to those are a lot of those GoFundMe accounts and stuff are just ways of raising money. Typically, that money's not going to come back to you. That's just something. That's a way to. But a lot of the Kickstarter, for instance, they may offer a prototype product. If it's a young band, they may offer the first live record or the first recording that they're working on. So if you're willing to donate money, you get something in return. In our business, what we're doing is we're lending money, and we're then recapitalizing ourselves. So we actually lend the money, we close the loan, just like any other private money or hard money lender would do. And then we offer that loan to accredited investors that can buy in fractional pieces. So they can buy as little as $5,000 or as much as the entire note if they want. And we pass through virtually all the interest. So these investments are allowing individual investors to make up to 10% interest in 12 months.
So walk me through this, like from the very beginning. I am an investor. I'm a flipper.
Yep.
I'm a wholesale. I'm a whatever. I've got a property. My acquisition is $80,000. My rehab's $20,000, whatever.
Yep.
And I'm going to you for a $100,000 loan. Let's forget about all the other BS. Just say, okay, cool. You're going to get a $100,000 loan.
Yep. Without getting into the specifics,
Right,
you're buying it for 100. So
I'm getting a loan for 100,000.
Right, but you said you're buying it for 80, right?
Right, with 20 in rehab.
So we're not going to go up to 100% leverage. We're going to be at best we're going to offer 85%.
But what if I'm buying like super deep?
It doesn't matter. We're still going to. You got to have some skin in the game. There are some hard money lenders out there that will go 100%. We don't do that. We want our investors, the borrowers, to have some skin in the game.
So let's forget about that. Whatever. Anyway, I'm getting a loan for $100,000.
Absolutely.
Okay. So does your company and I don't know how many other crowdfunding, how many other competitors y'all have, but let's just say in this industry, I go to you, I need $100,000. Now, do you have $100,000 right then and there, or are you going out and fishing for other people to
great. That's a very common misconception on how this is done. And really, originally in the old days, in the beginning of our company, we'd find what's often called a sponsor of a project, which is a flipper, and he'd say, okay, I need $100,000 in the situation that you explained, and we would then say, okay, give us some time. We would go find people that were willing to invest in that project, right? Obviously, that time lapse. One of the main reasons people go to private money is to close quickly.
Yeah, it's a phone call. Hey,
right.
Bob, can I have $100,000? Yeah, cool. Yeah, you get your money back 3 months. Cool. It's wired tomorrow. Click.
So
Bob.
absolutely. So our founders realized very early on that trying to raise money project by project wasn't going to work. Mm-hmm. So they were able to go establish a warehouse line, get some credit, use their leverage in order to fund a loan. And that's exactly what we do today. We fund every loan with our own money. We generally fund in as little as 7 days. And then we will offer that. We recapitalize ourselves two ways. We'll either sell the entire note to an institutional investor that's buying those notes, or we offer it to our crowd. And our crowd we've got about 20,000 people signed up on our crowd, and we've got about 1,500, 2,000 active investors that are constantly looking for deals. So we will fund the deal, we'll close the deal, right? And then we'll launch it. We launch on Tuesdays, Thursdays, and typically Saturdays. And typically there's going to be 3 projects on each of those launches. And the launch is a simple email. And so 1,500, 2,000 people will actively look at that deal. We're selling out our deals sometimes within minutes. Often, rarely will you see, if we launch a deal on Tuesday, will you still be able to participate on Wednesday?
So before I get into that aspect of the business, let's stay on what most of us here are the hey, I just want money.
Absolutely.
At the end of the day, I don't care that 17,000 other people have their money, their whatever in the piggy bank. All I care about is I go to you, you fund my deal, cool. Do I have a deed of trust? Do I have a promissory note with you, or is it with you and then those 17 people, or how does that work?
Right, that's great. That's a great question. So we actually have the first lien.
Right.
And so it essentially works like a promissory note with everybody who wants to participate. So there's fractional investors. They all come in, and it's our responsibility. We pay interest every month, and then when the borrower pays us back in the principal, we in pro rata distribute that money out back to every investor. And then we hope that they just find another deal and keep reinvesting. And again, we're paying up to 10. I think our fourth quarter stats, which are on our website at patchofland.com, under the About tab, you can look at the stats page, and it'll tell you, I think we're at a little over 10% for what our return to investors has been. And we just constantly to redistribute either the interest payment or the principal payment as it comes into us.
But ultimately, as the flipper, I don't care where the money's coming from. All I care is that I've got
Absolutely.
access to money.
Absolutely correct. As the borrower in this instance, we're just like any other private money lender. We are able to we're typically faster than a lot of other private money lenders, and we're heavily based on technology.
Right.
We are able to underwrite the loan fairly quickly. There's still documentation, and we do a full appraisal on the project. Which is typically the thing that takes the most time.
So as an investor, what are the benefits of, say, going to someone like yourself versus a hard money lender versus a private money versus Uncle Joe Bob with his piggy bank?
Yeah, I mean, that's a good question. For a lot of the straight down the fairway kind of deals, we're just super competitive. There's a lot of money out there. We offer really great customer service. We offer good rates. I mean, our rates are typically in the 8 to 10% range, a couple of points to close. And like I said, we're fairly quick at it. The one thing that the crowd does for us that makes us a little bit different is we can do some projects. As long as we like the deal, we can still fund it, and then we can recapitalize by selling it to the crowd investors, which most private money or hard money lenders have a very strict box, and they can't deviate from that box because their investors have decided that this is what we're willing to allow you to lend on, and if it doesn't fit in that box, then it's a no.
Right.
Whereas when people bring us a deal, if we like the fundamentals and we think it's a good deal, we have more options to recapitalize ourselves.
So maybe going through crowdfunding is not so much a box, but more of a jagged edge.
Yeah, exactly.
Oh, that's kind of cool.
Exactly. Well,
even though that's a fringe thing, I kind of like that.
Yeah, right. And we're not just a fix and flip lender. We do some commercial projects. We'll do commercial loans on properties for everything from storage units to some hotels and small office buildings, retail strips, and multifamily. And we'll do up to $3 million on that. And typically, all on the commercial stuff, it's all going to our crowd, as well as we also do some new construction. So we're able to put that on the crowd.
Right. So what about like in the spectrum of, so I understand that with a hard money lender, the hard money lender, they're in their box, and private capital is usually just your ability to sell the project to your source.
Right.
But I think we were talking on the phone last night about how Uncle Joe Bob, family money is always the easiest money.
Yeah, definitely. And that's we lend to very inexperienced and first timers in many cases, all the way up to guys that are doing doing 5 loans a month with us.
Right.
20, 30, or many more deals than that a year. I always say, and I feel like if you can do your first deal with friends and family money, you absolutely should.
Right.
Private money's there because it's difficult to do these kinds of loans with a bank, and so that's why private money exists.
And I don't think you're going to get private money until you actually have a resume, have experience, have a reputation.
It helps. That's exactly in most cases we will offer a little better rates as you gain experience. So the highest rate we're going to offer is to somebody who's never done a deal or only done one. You get into 3 or more flips, you're going to get slightly better rate. It doesn't have to be flips that we funded. It can just, as long as your name's on the deal and you can prove that you did the deal, because and you guys have talked about this on the show, probably more than anything else, experience in this business matters.
So what I'm hearing though is it's not, because I know hard money is always asset based. Most lending in real estate is always asset based lending. So with you guys, I know it's a cross between asset based and experience, but does my credit even matter?
Well, your credit does from a FICO standpoint. We'll do a credit check, and we don't want to do deals with people that have really bad credit. Again,
Right.
we have to assess a risk of the deal.
The reason I bring that up,
like a 600 FICO though. I mean,
Right.
so that's a pretty low FICO.
Well, the reason I bring that up because I know a lot of investors dropped out of high school.
Exactly.
They never went to college, never do anything. And I know myself included, my credit was shot by 18 and a half years old. So I know a lot of people are always starting at a negative.
Even if you didn't do anything to screw up your credit, you've got to have, most banks are going to require 2 years of W-2 income.
Right.
And if this is your source of income, you don't have a W-2, right? So you may have really good, You may have a really good balance sheet. You may have a lot of money that you can work from, and you're trying to use leverage. So we don't, we are looking, we're looking at the value of the deal. We're assessing risk on what is the asset costing, what's the after repair value going to be, how much do you need, what kind of construction budget are you going to put into it, and what's it going to be worth? What are you likely to get when the work's all done?
So ultimately, from an investor, from I need money side, I honestly don't care that it's crowdfunded, crowdsourced, crowd whatever.
Right.
All I care, it's a different strategy, it's a different source. And if you're an investor, you should always be I don't know the word there.
What are you looking for?
Gardening, cultivating.
Mining, yeah.
Mining. You should always be cultivating
Yeah.
more sources for capital, whether that be private, always networking with your hard money guys, getting better terms, going over to you guys and try to get the best terms there. And then, work them against each other. Hey, well, Robert's giving me this. Well, Joe Bob's giving me this.
And it's definitely a very competitive business. And I think probably the thing, we have a very high repeat. Once you've done business with somebody you can count on and the money's going to be there, I mean, this is a business that time matters. Time is money, as they say.
So what about the negatives from, again, I want to keep it in two lanes here, and we're still in the, I'm using your capital money.
Right.
What are some of the negatives about your industry of going against you, or not going against you, but using a source like you versus other sources?
Well, I mean, I guess probably the biggest negative if you're out looking for money is it's expensive money. Even at some of our best rates, you're going to be in the high sevens. If you can do this with friends and family money, or you've got other money, it makes sense to do that. There are a lot of guys that understand the value of leverage. So even if you do have the money, you may want to deploy the money for your rehab budget rather than your acquisitions. But that's probably one of the biggest. I think that's one of the biggest negatives. The advantages obviously speak for themselves. If you don't have the money, the way there's typically a fair amount of profit to be made on a good flip, and the amount of money you're spending to borrow your money relative to the profit you're going to make on the flip is kind of marginal.
So is there any other questions, any other points that I forgot to kind of draw out of you in this lane?
I think the other thing that's kind of interesting, we have two businesses in one, kind of with, I guess we could talk equity versus debt, right? That's another way. Sometimes the crowdfunding sites you may hear, and investors want to have an equity position. So in other words, they get some upside. So if they're going to invest in you with your deal, they want to have an upside. So if you make a lot of money, you get to make more.
Are you talking about from
an investor standpoint?
Well, we're not there yet.
Yeah, I'm sorry, I jumped ahead.
I'm still on the this track here of I'm a flipper. I want your money.
Yeah,
is there anything else I missed on that aspect?
I don't think so. I mean, we kind of nailed that, didn't we?
Okay. Well, what I'm hearing is if I need money, I can go to Robert.
You should come to Patchaland. That's what you should be hearing.
I'm trying not to be all sales pitch.
Yeah, no, I hear you.
Salesy over here. I'm trying to, let's talk about industry wide.
But I mean, so what are you thinking about? I mean, what other kind of downsides?
Well, I don't know. That's why I was asking.
If you default, you're going to get foreclosed on, right? So there's a risk.
So that's a great question. If you default, who is so I'm assuming because Patchaland has the first lien.
Correct. It's our responsibility, and it's up to us to work you out. And the first thing we're going to do, the last thing we really want to do is take that property back.
Right.
We're going to get in touch with the borrower. Sometimes it's as simple as a clerical error. They forgot to make a payment, or a payment bounced, or something happened that can get resolved relatively easily. That's absolutely the first thing we're going to do. And the last resort is, we obviously have first lien on the note. We're going to foreclose, and we're going to make our investors whole. And if we do the underwriting correctly, which we generally do, we will, and which is again part of why we require that our borrowers have skin in the game. So if there's going to be money to get lost, it's going to be because of a bad project. It's going to be on the borrower and not our investors.
You know what I wish I had right now? I wish I had a button that could cue up Travion to kick in that Rihanna song. Bitch, better have my money. Anyway, sorry. I just thought that was funny.
You need that.
So, but before we get into the other side of the business, I do want to just tell everybody, hey, if you're liking what you see here, please give us a like, please give us a share. The new Facebook algorithms kind of killed us on our ability to get it out there. And if you know us, you know we like to share in the groups, and they don't like us there either. So give us some likes, give us some shares. Share us in your favorite group. That'd be helpful. If you haven't gone to Patch of Land, go to Patch of Land, give them a like, check them out. And if you've never added me as a friend, add me as a friend. I like friends.
Add Patch of Land as a friend too.
There
baby.
you go. I did. I said go to their page. And then Robert, I don't know if he's pimped out his Facebook yet, so you can send him a request, see if he does it. Also, if you've never tried out Propelio, give us a try. We have a 7-day free trial for comps, leads, lead management, and we also are giving a shit ton of education away for free. So there you go. Now let's get into the other side of the business.
Nice.
Which is, I don't want to say investor. It is an investor, but it's, say the first half of this conversation was the flipper side. Let's talk about the investor side. Okay, so I know I have to be an accredited investor. What is an accredited investor?
So an accredited investor is somebody who basically has $1 million of net worth. This is our government's way of kind of protecting you from yourself, and so not just right, exactly. Thanks very much. It may change, but today's rules require that you have 2 years of W-2 income that you can prove that you've made $200,000 2 consecutive years, or $300,000 if you're married, and or $1 million of net worth, excluding your primary residence. So if you meet those criteria, you can invest on, and most crowdfunding sites only accept accredited investors. The difference, there are some sites that allow unaccredited. There's some rules about how you can solicit because of the way we do it. We elect to do it this way. We only want to take money from accredited investors. Again, this is a crowdfunding sort of thing. So if you don't understand the risk, we don't want to take money and put somebody potentially at risk that thinks they're going to get a 10% return with no risk.
Right.
You know, there is absolutely risk. Real estate's a risky deal. We tend to be pretty good, really good. We put our stats on the site. We want people to know how we perform. You know, and as they say in the prospectus, past performance is not no indication of future, but
disclaimer.
Yeah, we've done pretty good.
So, but on that, I know a lot of people are always confused of what is an accredited investor, and it's very simple, like you said, like Robert said. If you're single and you've made $200,000 or more for 2 years straight, and
you can prove it,
Well, I don't know if you want to prove it, but anyway. But then, or if you're married, you got to have $300,000 or more for 2 years straight. Or if you have over $1 million in assets outside of your home. What that means is if I have a $100,000 house and $1 million investment portfolio, I'm an accredited investor. If I have $1 million house and $100,000 investment portfolio, I am not accredited. I have a kick-ass house, but I'm not accredited. So that's just a quick, dirty, simple way to remember it. Okay, so I'm an accredited investor.
So, or even if you're a real estate investor that has the ability to prove that you can be accredited, you can either buy a property, put a construction budget together, a rehab budget, do the work, or hire somebody to do the work. 6 months, 8 months, 10 months later, put the house on the market, sell the house, and make a profit, right? If the profit you're going to make is going to net you 10, 11, 12% on your money, right? Or you can literally call up a website, shop around, put $5,000 in this deal and $10,000 in that deal, or spread it around, or put it all in one place, and 6 to 8 months later get the equivalent of a 10 or 12% return without ever having to leave the comfort of your couch. That's something that you might want to consider.
So you're talking about the difference between an active investor and a passive investor.
Exactly. And I think there's a lot of people on our site, there are people on our site that are actually real estate investors that do flip homes, that see this as another way to diversify what they do, and they have the ability to look at a deal, they can look at leverage, they look at the rate, they look at the location, they decide, yeah, this is a good deal, I want to be in this deal. And so it's particularly like in today's market where inventory is such a problem,
right?
You know, so this is a way to kind of hedge. I'm not doing as many deals as I'd like to be doing, but I've got capital sitting around, I've got money that I'd like to be making money on, so you can make money on somebody else's deal.
Yeah, because I know in this market, DFW, you've got stupid money. Like people are, 10 years it used to be 65% minus repairs.
Yep.
And now it's like, you're lucky if you could find a 75% minus repairs, because you do have bigger boys coming in here, the hedge funds, whatever, who are buying at the 90% minus repairs because they're banking on volume. And if you and I'm going to say a little guy being somebody who's only doing 50 deals a year or something, that's still a little guy compared to these, hundreds of thousands of houses. You can't bank on volume. You have to have those margins. So like even me, 75% minus repairs is that's the max.
Right.
But okay, so I've got a piggy bank because I just flipped a house and I've got a lot of money, but I can't find another deal. Okay, I go to Patch Land. You're like, hey, look, I can potentially get you X, Y, Z.
Right.
Is that right?
Yeah, that's exactly right. I mean, and you said 75. In some cases, we can get you up to 85% leverage. So typically, 75 to 85 is a good number.
Well, I was just talking about as far as I'm not
in terms of the return for an
talking
investor.
about like as a return of where I'm buying it. I'm not talking about the money itself. I'm talking about just I need to buy 75% minus repairs, like 75% of the ARV minus repairs.
Yeah, you're looking at your deal.
I'm looking at a deal for me.
Right. Yeah. And that's.
I'm still trying to get 100% financing.
Yeah. Well, dude, keep looking. I mean, it's out there. I think it's a little crazy, but it's out there for sure.
But okay, so from an investor standpoint, I go to Patch Land because we met at a networking event, and you're like, look, I know you can't find deals, but I can get you. I could potentially get you because there's no guarantees in this world. If somebody's guaranteeing, slap them, right?
Yeah, absolutely. I mean, we will quote you what we think we can do, and then we're going to do an appraisal, and then we're going to get it through underwriting. So until it goes through underwriting and we're ready to fund, there is absolutely no guarantees. That's absolutely right.
Okay, so I've got $100,000 because that's easy math, and you have this magic email list that you blast out, and there's a deal for $100,000, but I only want to spend $20,000. And you talked about fractional investors earlier.
You can put as little as $5,000, and actually, we've just made a change to that where you can get into a deal for as little as $2,500.
Mm-hmm. So how does that work? I mean, am I getting an X% return? Because I know if you're charging 10%, 12%, 14%, whatever your rates are to the investor, what return am I potentially getting from my standpoint?
Yeah, so we're going to keep a tiny little bit of the spread. I mean, we're typically
as the sponsor.
Yeah, well, there are some fees to manage it and stuff. So if I do a loan with you at 10%, let's say, we're probably going to offer that to the crowd at 9.5%. Okay. That's typically, there's about a half a point. Some deals, depending on the size of the deal, we might take 25 bips or might take 75 bips on some. It's just. But our business is highly dependent on we're making our money in the profit on our deals on the points.
And for those of us who did not work at a hedge fund, what is a BIP?
A basis point.
Okay. And what's a basis?
It's a hundredth of a percentage point, basically.
Math. It's sexy. So okay. And this is a question I forgot to ask before, but I know basic hard money is usually a 6 month with a balloon. Is that the same standards, or what is y'all's time limit on that side?
Yeah, we have a couple different products, but primarily let's talk about what the majority is a 12-month interest-only loan, and you can pay it off anytime you want. And we're just like our customers. We want to see that project move quickly and get our money back as quickly as you can get through the project and get the house sold. So we don't want to penalize anybody for paying us off early. In fact, that's the key to our business: is pay us back, get into another project. Do it, rinse and repeat.
Mm-hmm. Now, going back to, because I know I just bounced on you, but now we're going to bounce back to this lane. I'm an investor. I've given you 20. Well, not you, but I've given the deal itself 1/5 of it, and I'm getting 1/5 the returns. What happens in that foreclosure standpoint, where yes, Patch Land's the first lien? Does my entire investment get wiped out, or am I looking to you once you've figured it out, you're going to pay me off?
Yeah, that's exactly what we do, right? I mean, so you will probably, in a project that's in trouble, the borrower quits paying interest, right? So there's no interest for us to distribute. So that's your first sign that something's wrong. You're not seeing an interest payment. We typically, we would then communicate with you. via email. You're going to see it where, an alert that we are aware of an issue. We're going to start resolving that. Most of the time, it's resolved fairly quickly, and it's, like I said, just some sort of error along the way. If it's something more serious, where they pulled down a wall, or there's just they run out of money. There's all sorts of reasons that people end up defaulting, and so we've got the first lien. It's our responsibility to take that property back, and then we'll sell it to another investor. Try to get everybody whole. To this date, we've returned 100% of principal to every investor that's ever put any money on our site. I can't say the same. Not 100% true for the interest promised, but as far as principal, nobody's lost any principal.
So on that though, so you do foreclose and you're able to sell it at a profit. Does that? Yeah, do you distribute
that?
That
absolutely happens. That's exactly right. We distribute in pro rata fashion to everybody involved in the deal, regardless of how we work it out.
So there's not like an oh gotcha moment where it's like, well, Patch Land's gonna woohoo party.
Nope. It's every deal is set up as an independent deal, so we don't mix and match things. This deal gets worked out, and another deal is having a different type of problem. There's no blending of that.
What's the worst case scenario from a passive investor given? And again, I don't want to say given Patch Land money, but given the deal money. What's the worst case situation?
Yeah, I guess the worst case in any investment is you lose your money. Right. With the reason these deals are so attractive and what we call that asset-based lending, if you've got an asset backing up, as opposed to these companies that do small business loans or student debt, if somebody defaults, there's really no, or a consumer debt. I got $20,000 worth of credit card debt. I go to one of these firms and they give me the $20,000 to pay off my debt, and I'm now paying them a smaller rate of interest. I'm not paying 22% interest. I'm paying a lesser rate, and they've sold my deal to hundreds or thousands of investors that are in it as little as $50, let's say. If I just stop paying, it's really hard to recover that money. So all of those investors are at risk of
wiped out.
Yeah, you can't get that money back, which is why typically nobody's putting huge, large amounts of money. Nobody's going to buy a 150, or I'm not going to say nobody, it does happen, but in our situation, we've got this asset backing that loan up. So if we've got to take that house back and the borrower is only at 75, 85% leverage, there's some room there for there to be a loss, and we can still do a workout and get everybody their money back. Because there's an asset behind that loan.
So flip it, best case scenario, what's the best case scenario?
The best case scenario is exactly that. Like I said, this is a debt investment, not an equity investment. You're going to get exactly what we promise you, which is what typically happens.
So there's no overages, there's like woo.
No, because there's none for us either. We're a debt-based lender. So we're promising 10%. We pay 10%. That's all there is to pay.
So earlier you had mentioned this, and I don't know if it was from this standpoint, because I know up to now we've been talking about individually financing individual deals, like 123 Main Street, I want a piece of that. 234 Main Street, I want a piece of that. Yep. Is there a way to just say, look, I want to be even more passive than that? Is there a way to say, hey, here's $100,000, just give me percentages and do with what you will?
Yeah, right. That's typically
like a mutual fund.
That's a REIT, a real estate investment trust, or it is a fund. And that's something that's definitely on our roadmap for the future. We'd like to be able to curate certain projects into a fund and let investors just buy into the fund. Today, you have to pick an individual deal, so it is a fairly you have to be fairly active in the process of selecting which deals you want to be a part of, how much do you want to be a part of it. We do have a pretty cool feature on the investment side where we call auto invest, where you can say, this is the leverage I'm interested in, this is the amount of money I'd like to invest. You can pick the areas, and so automatically the platform will decide, before we launch a deal to the public, we'll sell it to everybody that's auto invested, and sometimes we completely fund a deal before the public even sees it.
So one thing I'm hearing though, it's like, say you don't have any flippers that are wanting your money, well then you don't have a business. And on the flip side, if you don't have any investors, you don't have a business. So it seems like, are you always hunting for money, and you're always hunting for people to place that money?
In a sense, I mean, our crowd has really grown organically to where it is today. I mean, it's a fairly new industry. It's, people obviously share with their friends. I've made some money on this site. You ought to look at it. So in terms of our crowd, we haven't had to work that hard and like I said, the vast majority of the deals we put on the crowd are selling out in minutes, if not hours, rarely days. It's just our crowd is what we call hungry for those deals. There's an appetite for what we're putting on them. And then, on the institutional side, there are plenty of institutional investors that want to buy those whole notes. And that's what a lot of hard money lenders do beyond their own money. So they will sell it to a firm or a hedge fund backed by Wall Street that wants to buy these notes. And there's a lot of appetite again for that as well.
So, not to plug competition, but, in this industry, I've only really seen patch of land in this marketplace. Is there other competition in this marketplace for what y'all are doing, or are you the only people that are doing it?
No.
I mean, you don't have to name them, but I've just never seen them at events or anything.
Yeah. Well, we're pretty aggressive in our marketing, but there's definitely, from a borrower perspective, we're competing with straight cash, right? So literally, all the flips, there's maybe 250,000, somewhere in the neighborhood of 250,000 flips a year in this country. And a third of them are done with financing. So that means 2/3 are done with straight cash. So all of the hard money lenders in the country are competing for literally a third of the flips that are being done. There's local hard money guys, which typically, sometimes, I was with some this weekend. It can be as simple as a phone call sometimes. I need 200 grand, it's wired, it's done. They know the neighborhoods, they know the address, they know the properties, they know the values, they feel good about it, they can move very, very quickly. And that's one of the advantages to a true local hard money lender. There's quite a few, but there's probably a half a dozen national platforms like us that are lending all across the country. In fact, we're in 45 states. And we're using data. We're buying data, we're using appraisals, we're using technology to help us figure out, is this a good investment?
So it's almost like, the crowdfunding is the central key to your business, but you look at all sources of financing as competition. Like all the other hard money lenders, all the other lenders, that's competition because essentially it's a source for capital.
Again, the crowdfunding piece is on the backside.
Right.
For a borrower, they don't care. Yeah, it's not important to them. As long as you have the money when they need to close, they're good, right? They don't care what you do with it.
It's still interesting to know though, because I think most people think like a hard money lender. It's like, wow, Joe Bob, the hard money lender, man, must have deep pockets because they're sourcing a ton of deals. But the reality is, they probably have either a line of credit or they have private capital backing them as well.
Yeah, right.
But people don't think about that because ultimately we don't care. We just want to fund our deal, and
Exactly.
we're very, narrow-minded and thinking only about what ourselves.
There's even companies out there that'll, go after private money lenders. Let's say I'm a private money lender and I've got $100 million to lend, right? So it makes the most sense if I'm lending at 12% and 3 points, or 12 and 4 even. I've only got 100 million, and if I've got, it doesn't go very far.
Right.
When you're this is a multi-trillion-dollar industry, and
right.
So if you've got $100 million to lend, there's no point in bringing your rates down, and creating competition among among your local market that wants that money and is willing to do business with you on those terms. So you might as well, you're limiting your own profits by bringing your rates down. So, again, we're kind of coming in, we're disrupting that a little bit because we've got essentially unlimited access of capital. So, and we can bring the rates down, offer the borrower a little better value, and we're doing it on scale. So, we've got well more than $100 million available to us to lend. So the more, like I said earlier, we're typically working on origination points. That's got to cover our operations and our profit. We're not as focused on trying to make spread.
And what is your origination typically?
Typically, we're going to make 2 points, maybe 2.5. Again, there's so many factors in the deal, but we got to look at the individual deal. Often there's a broker, there can be a broker involved, and the broker needs to make something, so it might be a little higher than that.
So we're wrapping up here. So if you have questions, please drop them in below. If you haven't already, give us a like. If you've already liked it, well, guess what? You can keep on touching that like, thumbs up, heart button. It's all good. Please share it to your personal friends. Please share it around to all the groups. If you haven't checked out Propelio, check out Propelio. If people want to get a hold of you, Robert, how do they get a hold of you?
They can start by going to patchofland.com. That's always a great way. They can call us at 1-800-959-1465.
Excellent. And as far as you're looking for potential borrowers and you're looking for potential accredited investors.
Sure.
Correct?
Yeah, I mean, that's the market we serve.
Excellent. Well, Mr. Moore is up to the bat. Mr. Moore?
Hey, if you're paying 10% on the debt that the investors are providing, what are you charging the flipper that's borrowing the money?
Like I said, we're typically going to make about 0.5 point, so they're going to pay 10.5. It could be as low as 10.25, but there's typically not that much spread between what we offer and what we're charging.
Okay, if somebody wanted to invest in some of this and go in and put a little bit of their capital into this, where would they go to find out more about doing that?
Yeah, there's a lot of resources. I would definitely suggest you look on the web and read some articles. There's tons of content out there about crowdfunding and real estate crowdfunding in particular. We've got a lot of resources on our site, but you can just go to patchofland.com. There's 2 big buttons. There's a borrow button and an invest button. And if you click on that invest button, you'll start the process. It's free to sign up. You can hunt around, read a bunch. You can actually look at deals and see what's available. And what we've done. Ideally, look at what we've funded in the last few months. Get a feel for what our offerings are.
What is the liquidity of an investment like that? Like if I drop $100,000 into a note and then 3 days later I decide that I need to go to Hawaii.
Yeah.
How fast can I get my money back?
No, you're locked into it. You're going to have to. Again, these are 12-month interest-only notes. Most of the time, we're paid off at about 8 months. So your money's going to be locked up for as much as 12 months. But typically it's going to be a little bit shy of that, just in the nature of the business. Most guys don't take a year to do a flip.
So how do I qualify a lender? What should be some of the questions I'm asking if I'm working with a lender? What are the things I should be careful of and think of when I'm asking and working with somebody new?
Yeah, that's a great question. Obviously you want to understand what the rate and the rate and term. You're going to want to understand what the cost to close are, which includes your origination points and application fees, appraisals. If you're going to have a construction component, what's your draw schedule going to look like? How much is it going to cost you to draw down money? What's the frequency? Some lenders will charge you interest. Let's go back to your example. If it's an $80,000 acquisition and you want to do $20,000 worth of construction, some lenders are going to charge you $100,000 interest on $100,000 from day one. Mm-hmm. We do what's called, it's often referred to as a New York style loan. So we only charge interest on funds dispersed. So if you're going to take 4 draws of $5,000, you're going to pay interest on the $80,000 on the acquisition. And then when you pull down your first $5,000, you're going to start paying interest on that. When you pull down another 5, you're going to start paying interest on that. So and that can add up, especially on bigger loans. That can be as much as a point or more of the total cost of the loan. So I think that's a really valuable thing to look at.
And because it's a New York style loan, if you don't pay, you get a crowbar to the knee?
I don't think we've ever done that.
Alleged, or legally or not legally, or no, we have never done that, wink, wink.
No, but I don't know where the term New York style comes from, but it's basically that refers to as the interest on funds dispersed.
Well, excellent. Did we miss anything? I know, when we were talking on the phone, you're like, crowdfunding, that's like a 5-minute conversation. Like, I don't know what you want to talk about after that.
Well, I can't believe that we've been talking for nearly 45 minutes. I had no idea that this would go that long.
I love to talk. So, did we miss anything? Did we cover it all?
What do you think we missed?
I don't know.
Is there anything coming at us on the feed?
Well, that's what Daniel just did.
All right.
That's what his.
Oh, that was it?
Yeah.
I think
Putting you on the spot.
I think we didn't talk about the outlook for 2018 and
Do you
what's
have
going
an outlook
on.
on 18?
I've only got mine, and so I
would love to hear your opinion.
I just think that we've been saying for 2 or 3 years now that this is only going to hold out. The market is with this robust market's only going to hold out for 2 or 3 years, and we've been saying that for 2 or 3 years. So I don't think we're going to have nearly as dramatic of a downturn as we had in 08 and 9.
Right.
But I do think
there's
guys,
corrections.
there's a lot of people doing this that have very little experience, and I would just everybody just do your homework, make sure you're in a good deal. If you've got a lender that says I don't want to fund you, you should probably take that to heart. I like to say, if we're not willing to do the deal, you probably shouldn't do it either.
So basically, know your numbers, and you can get your numbers from Propelio.com. Again, how do they get a hold of you?
Go to patchofland.com or 1-800-959-1465.
Excellent. Well, Robert, thank you so much for tuning in. You didn't tune in, you were here with us, but thank you for being with us.
Yeah, no, it's great to be here.
Everybody out there, thanks for tuning in. If you liked it, give us a like. If you didn't like it, come on now, it's free. Just give us a like. Give us a share. Tomorrow, Grant will be back in for Grant Teach Me Something. And then next Monday, or actually this Monday, like 4, 5, 6 days from now, we'll be in San Antonio for the San Antonio REI meetup. That's going to be fun. That's February 26th. So if you haven't signed up, sign up. See us there. Robert, thank you.
You bet.
Everybody out there, thank you. And we'll see you next time.